Today, you are going to learn the easiest way to hedge a position or your entire profile. I don't want to make this a super edited, highly, processed video. I want this to be as raw and as easy for you guys to understand as possible because the thing that I've noticed in my 8 years of doing this is that people believe that hedging is insanely complicated, which it can be, or people just think it's super easy. You just go buy the opposite of whatever position you have, and then they lose a ton of money because they don't understand the Greeks. They don't understand why they're hedging. They don't know if they're fully hedged, etc. So we're going to talk about this, and we're going to use Tesla as an example because I've been talking about wanting to open and hedge on Tesla as we start to move our way back up because I think we're going to probably get rejected, but I don't want to sell my long-term position. So hit the like button, subscribe, check out our Discord community. It's completely free. Link in the description. You get access to free courses, free live streams, free seminars, free webinars, as well as much, much more. And let's get into the video. So I talked about Delta in a video that came out a couple of days ago on the channel. It's a 2-minute and 45-second video. I highly recommend you watch it. It's very simple, very straight to the point. But the easiest way for me to explain Delta to you within the next 10 seconds is that your Delta is how much money you will make for what the underlying does. So if we were to buy a call on Tesla, let's say we were to use like a 185 call expiring 1 year from now. If I were to purchase this contract for $4,500, for every dollar that Tesla goes up, I will make $64 per contract that I hold. So your delta is basically the sensitivity to the underlying stock. So the higher the delta, the more money you'll make, right? But it doesn't mean that's the higher percentage you will make because obviously this contract costs a lot of money. So what you need to think of when you want to hedge an options position, or if you want to hedge a shares position, whatever that is, you have to realize what is your delta. That's the first thing. Now, a share in a stock, a share in a company, not a share in a stock, a share in a company is one delta. It's a delta of 1. So let's say we owned 1 share of Tesla. If Tesla goes up $1 per share, we go up $1 per share, which means our delta is 1. So let's say that we own 100 shares of Tesla and we think, okay, we want to hold this long term, but I'm really not a huge fan of what's happening in the market currently. Well, what you would want to do, let's say you want to put a ceasefire on, you want to completely stop, you don't want to sell the position, but you want to make your portfolio not have massive moves to either side. What you would want to do is become delta neutral. Is what we call it. I believe that's what it is actually called. I just call it being delta neutral, which is meaning we're evening out our delta. So let's say that we have 100 shares of Tesla. Well, guess what? Our delta is now 100. Okay, because each share is 1 delta and we have 100 shares. Well, in order to actually cut that out, what we are going to need is to put a negative 100 delta on our account. So we have a positive 100 delta because we own 100 shares of Tesla. Each one is 1 delta, meaning if each share goes up $1, we will make $1 per share. Meaning if it goes up $100, or if it goes up $1, I'll make 100. And the opposite, if it goes down $1, we'll lose $1 per share. So what we have to do is put a hedge in place in order for us to remove the delta entirely. Now, for me, when I'm putting a hedge in, I'm usually not going to go getting an option that's 2-3 weeks out, right? I'm normally going 6 months to a year out because most of the time I'm hedging against a long-term position. I'm not usually hedging against a trade. Most of the time, if it's going to be a trade that I want to hedge against, I'm just going to do something like spreads or sell some cash secured puts. So what we need to find now is a negative delta that will be equal to our positive delta. So remember, we're a positive delta of positive 100. So let's say we were to buy a put expiring March 15th, 2024, 365 days from now. You can see this contract is a negative of 35 delta, right? It would be 0.35, but you have to times that by 100. So this would be 35 delta. Now for layman's terms, if we were to buy 3 of these, it'd be a little bit more than 100, but whatever. We're going to say that if you were to buy 3 of these contracts, you would be negative 100 and some odd delta, about like 115 delta is what you would end up having. Or I'm sorry, 105 delta. So if we were to purchase 3 of these contracts, our portfolio is basically neutral. We're a little more to the short side because we'd have a negative 5 delta, but we're basically flat. So that means that as long as the delta stays the same, our portfolio is not going to move. Tesla could go up, Tesla could go down. It's not going to move. Now, here's the thing. Delta does not stay the same every single day. Delta will continue to change. So let's say tomorrow Tesla dumps. This contract gets worth more money and the delta goes from minus 35 to minus 45, meaning we will make more money per $1 move in Tesla. Well, now we have to rebalance the portfolio because, as we've said before, I'm going to have to use my trusty calculator. If our delta was 35 or negative 35 and we times that by the 3 contracts we now have a delta of negative 105. But if the delta pushes to, like, let's say 45 per contract or negative 45 per contract, and you're to times that by 3, now we have 135, a negative 135 delta on our contracts. But we still have a positive 100 delta because we're holding shares, which means what? Net, our account is negative 35 delta. So, meaning we're basically short 35 shares. That's all that means. When you see negative 35 delta, as you see right now, it just means that if you were to buy this contract, you're basically short 35 shares of Tesla. Now, we have to rebalance this. And this is where being a portfolio manager comes into place, right? If you wake up the next day, your delta's higher, you have a negative delta of 135 and a positive delta of 100 because of your shares, you're going to have to rebalance the portfolio. Now, how do you do that? You buy more shares. We would buy 35 more shares of Tesla because 1 share is 1 delta. That would bring our portfolio back to normal. And then whenever you want to kill the hedge and take the hedge off the table, you would just sell out of your position entirely. This is what I did during the pandemic because I didn't want to close my positions. I wanted to have my long terms, but I didn't want to deal with watching the market bleed. So I opened a ton of positions. Now, before we hop off, we're going to talk about a half delta or putting a piece of a hedge in. I'd be quite honest, I really don't know what the hell the name of a half delta would be. That's just what I call it. But it's basically if you want some exposure to the actual asset, whether that be Tesla, whatever stock it is, but you don't want to have full on exposure from the very beginning, but you don't want to be delta neutral and not have your portfolio move at all. Well, something you can do, which is something that I do a lot, is I would take a half delta. So let's say I have 70 shares of Tesla, and I think Tesla's going to do really well for the next year. Next couple of weeks, I don't really know how it's going to be. Well, if I have a delta of 70 and I wanted to just minimize my risk, I could cut the delta in half. How do I do that? Well, I open up a put position. So what I would do is go find whatever half of 70 would be, which is in our case right now is 35. I don't have to use a calculator, but we could purchase this contract right here and be at half delta, which means that we would really, instead of being long 70 shares, we'd only be long 35 shares in the interim. And then from there, we can decide to continue to rebalance it, continue to add more shares, continue to pull more off, continue to add more potential put positions to bring our delta back down. But that is how you hedge a position. It is very, very, very simple. Now, there are specific spreads, specific legs if you're doing options. There's a lot more, but understanding the basics of how to hedge out a position is extremely, extremely important. I hope this video helped. I know you might have to rewatch it a couple of times, but it is one of the simplest things that you can understand once you understand how much delta is on your portfolio at a single time. Thanks for all the support, guys. Have a great day, and I'll see you guys next time. Peace.